Welcome back and happy early Christmas to everyone.
Tough week again. Where the Santa rally at?
Let's hope it's coming soon. What's on the menu today?
Today we have our take on tech stocks in 2022 using Adobe, the OG subscription companies earning this past Thursday.
I like that. We'll be going over this week's Fed announcement and their general outlook for the year of 2022.
Looking at Adobe, this is a perfect example of what will happen to your stock price if the guidance is reduced by the company. But let's take a look at the earnings first.
Looking at the Q4 report card is honestly not a bad one. I'll give it a passing grade. Check screen for detail. So for full year non-GAAP EPS is $12.48.
Looking at those numbers, it's not bad. Why the big dip?
Bad guidance. The guidance is very important, especially for companies in this Q4, since the market is generally expecting slow growth for 2022 for a lot of companies. If your company didn't adjust the forecast up, the market is going to murder your stock price.
Wait, I think I get it. It's like when you're one of the best students in class and the class average for the final exam is low, but your grade ends up even lower. Your parents are not going to be happy about that. They might be like, come on, at least be average.
That's right. Adobe is one of the best software companies and one of the first to start the subscription business. And even they cut on their guidance. They are expecting 4.23 billions in the next quarter, which is less than 4.34 billions estimate. And EPS of 3.35 also missed estimates of 3.38. So it's a very clear slowdown in growth.
And for the whole year revenue for 2022, Adobe expects 17.9 billion, again missing estimate of 18.2 billion. And obviously, the EPS misses estimate as well for next year.
So let's look at Adobe right now. Closing at 556 Friday. Its PE is at around 44.2. If we look at Adobe's recent years, 2018 to 2019, the high PE range is around 30 to 45, which means after the drop on Thursday, the evaluation is still considered high pre-pandemic.
Interesting. This tells us the price that it was trading at for the past few months are way overvalued. Honestly, just like a lot of stocks, they are basically trading at next few years' expectation. If it's 1 year out, it could be fine, since the stock market is essentially buying the expectation. But if you're buying 2, 3, or even 4 years out, if the company's guidance for next year growth starts to slow down, then you're going to start seeing some big volatility in the share price.
Exactly. And if we look at this past year's EPS growth, which is about 23%, super high, right? So before the ER, the market is estimating for next year's EPS growth of 13.6%. Isn't that already a big jump in expectations? After the ER, the guidance is actually 9% for next year.
Wow. So like you mentioned earlier, the market already gave a discount on the expectations for 2022, and you can't even beat that. It's like teachers saying, guys, this final exam is extra hard. So if you get 30%, you passed instead of 60%. And you got a 20%?
Exactly. And I want to emphasize this is not just Adobe. This is for everyone next year. I think with the rate hikes, companies will have less power to borrow money. So they will have less money to spend, which is will directly impact their growth.
And that, of course, compared to whole year 2021, companies are making it rain under the Fed printer. Not saying it's impossible, but it will be very hard for companies to beat the growth in 2021.
Right. And for 2021, since the growth is high, everyone has high PE. And with that, stock prices are running up through the roof. But once the growth slows down, the market needs to cut the valuation, right? And once that cut, the stock prices will be starting to going downward.
You can say that, oh, who cares about valuation? Just look at 2021. Well, there you have it. I can tell you the institutions are not going to buy at high valuation. If they are buying, they will buy somewhere near low or midpoint in the growth cycle and just keep raising PTs.
Yeah, They're not gonna buy at high PE and tell you the growth can sustain, unless you are Kathy. But ARK is built different, and you are not ARK. She's got a team to buy low, sell highs every minute to average down. Do you?
Not me. I got a team of me, myself, and I. And I got a job. But anyway, back to Adobe. To summarize, the growth is slashed from 23 to now 9%. You tell me, can it still maintain high PE?
I would say the chances are not looking good. So using Adobe as an example, if other companies give out similar earning in the coming weeks, you can expect the market to react a certain way. Say if company give out similar guidance for next year, if you tell me that the market as a whole can still go up bigly, I doubt the institution can even say that without batting an eye.
So, after all that, where is your buy for Adobe for the next year's 9% growth?
Personally, I would target 430 to 520 zone and do it in phases.
I agree. I still have base position Adobe left. Average is 450. So I will be targeting that strong support with mid PE valuation. But honestly, if you think the market will still be willing to pay for around 50 for PE, then you do you, I guess.
Yep, to each their own. At the end of the day, is how you value your company.
Let's look at another ER, Fedex. I'm finally almost back. Yay.
Look at the screen for the report card. For the adjusted EPS of 4.83, surprisingly, is the same from the same quarter a year ago. This is a nice surprise for the market.
So looks like the fuel surcharge is working, but not too much. Everyone should keep in mind that FedEx will start raising base delivery fees starting January 1st next year.
So, where's a good spot to get FedEx?
We know that due to the fuel surcharge and base delivery fee raises happening next year, FedEx will be growing the fastest around mid 2022 to mid 2023. And since FedEx got beaten down quite a lot already, I'm adding FedEx around 220 to 225.
Don't forget FedEx announced a new share buyback program of $5 billion as well. So you can bet that the company will be buying their own shares on dips, not on rips. Always keep that in mind.
Another volatile week, all eyes were on Fed's latest policy decision and economic outlook. Like what we have discussed in last week's video, the Fed brought no major surprises at least.
Yep, as expected, they will double the pace on the tapering, and we will potentially see 3 rate hikes next year.
I guess this is somewhat what the markets are expecting from the Fed. The market instantly rips after Powell's speech.
And we gave it all back on Thursday and finished the week lower on Friday.
Yeah, tech is the pooper of the week, but the general takeaway for this week's volatility is that the central bank started to normalize policy and not so serious Omicron variant is getting more serious in the recent days.
The Fed is likely to conclude bond purchases in the first quarter of 2022, and we might have the first rate hike announcement around the same time. Also, New York just confirmed 20,000 COVID cases on Friday, which is the highest number of daily COVID cases since the pandemic began. So be sure to wear your mask, guys.
Yup, this thing is not over yet. Do what you can to protect yourself and your family. So, if the monetary policy became less accommodative, do you think the market is going to hold up at this level?
Well, I think that the economy is strong enough to be able to absorb the upcoming rate hikes. I can see the unemployment rate is at very low right now. Household finance are in good shape, and personal saving have reached a level we have not seen in a long, long time. Consumer spending remains strong even in a hyperinflated economy. I feel like the overall economy is prepared for some turbulence.
I agree. I think the current economy is no longer in need of emergency level stimulus, but we are definitely going to see some greater market volatility. But we should expect the bull market to continue in 2022.
Despite this week's pullback, I think we are still on track to finish the year strong. We thought the Santa rally began after Powell's speech. I guess we have to give it a couple more trading days.
Nasdaq closed a little over 3% for the week. The S&P 500 and the small cap down almost 2%. Once again, Russell revisits the bottom of the trading box. This is definitely another buy for us.
The Nasdaq and the S&P are currently sitting on support. Hopefully, this level hold into next week. We believe the Santa will come for us.
We have a couple of trading days left for the year. In case you forgot, now is a good time to focus on taxes so you can set yourself up to pay the IRS less. Now, how can we do that?
Well, first, you should sell off the underperforming investment. You may have some stocks sitting in your portfolio that aren't performing as well as you had expect them to be. If you are thinking of dumping those stocks to free up space in your portfolio, now is a good time to act before the trading year's end.
Second, don't forget to put money into a retirement savings plan like an IRA or 401k. IRAs max out at $6,000 for savers under 50 and $7,000 for those 50 and over. Meanwhile, for a 401k account, you may contribute up to $19,500 for the year.
Last but not least, if you have a health saving account, which is HSA, you may max it out with $3,600. These are some of the common options that you may use to not pay Uncle Sam's as much.
That's right. You still have time to sell investments strategically and add more money to a tax advantaged savings plan. So don't pass up that opportunity. You still have a couple more days left.
Thank you for watching. If you find this video helpful, feel free to give us a like and subscribe for more content like this.